Stephanie Link joins us now to talk about some moves. So, Steph, it's good to have you. I want to start with the stock that you actually trimmed because it really goes to the heart of our conversation that we led the show with, the unwind of some momentum trades. I talked about cyber, and you trimmed CrowdStrike. Tell me why.
Yeah. Because, Scott, I was buying it in the summer, and in the summer it had fallen about 41% from its highs as they had that glitch, the global glitch, if you will. And I thought it was an opportunity. I had never owned CrowdStrike before because I could never really get my hands around the valuation. But down 41% from its highs, I thought it was an opportunity for best-in-class company. Still is best-in-class, by the way, but it's up 97% from August 2nd. And I got lucky. I timed it really well. I was adding it throughout August. And so I just think it's prudent to take money off the table. It's not to say I'm negative on the name at all. In fact, I like the long-term story. You know I'm very much involved in cyber, and I use that money to put it into a laggard, which is Palo Alto, because that stock was only up 8% in the past year when everyone else is up 40, 50, 60%. And so I thought that was an opportunity. So still a very large position for me. I still expect a very good quarter when they report 30 to 40% earnings and total revenue and subscriptions. I just think that it was prudent to take some money off given the run.
Do you feel like it's prudent to do that for investors who are watching you now in a lot of the other names that we discussed at the top of our program? Ones that were in the momentum basket that had a huge run up? I mean, it's really not coincidental or, to me in any way that you're doing this today as we're watching a rollover of one of these great trades.
Well, I actually did it earlier in the week before we start major rollover, but I would have no problem with people taking some profits in any of those names because they're up so much. And when the momentum turns, look, momentum is great on the way up, Scott. But when the momentum turns and it's on the way down, the valuation support is very, very hard to use as a tool. So you either have to hold your nose and deal with the volatility, or you take some profits along the way, look for opportunities. Look, by the way, if CrowdStrike were to fall 20% from here, I probably would add it back. Right? But I just see value elsewhere in the market, and I wanted to take some gains. I think that's the prudent thing to do in my strategy, the way I invest.
Let's talk about taking that money and putting it elsewhere, because you bought more UnitedHealth and you bought more Diamondback. Tell me more.
Yeah, I mean, every day UnitedHealth goes down. It acts horribly. I bet the chart looks terrible, but I would just say I'm going to continue to make this a very large position throughout this year. This is the #1 managed care company in the world, and their long-term earnings growth rate is anywhere from 13 to 16%. But if you can get their medical loss ratio, if you could get that to come down to 2022 levels, then you look at something like 25 to 40% potential earnings growth. So it's all about the margins, and I think we've seen peak utilization, and therefore I think you will see margins kind of recover for the company. And the stock is trading at 12 times EBITDA versus 17 times its long-term average.
Yeah, and you don't have an issue. I mean, one of the things, obviously, is just the sentiment around the name has been so bad.
Yeah.
Fundamentals haven't really mattered. And I'm just wondering why you think they will. The stock hasn't done anything.
No, I don't think I think fundamentals have been not great, Scott. That's why the stock hasn't done that well. Yes, sentiment is bad. Yes, you've got Washington policy risk. I think that's overdone. And I think at this valuation, it's priced in a lot of bad news and a lot of the bad fundamentals. And I'm making the bet that this company, being the #1 player in the industry, will recover in fundamentals, mainly the margin side. I have no problem with their product growth. Optum is their gem. It's 25% of total revenues. It has an operating profit growth of 12%. That's the driver of the growth in my mind. And if you can get the margin side fixed, then I think you see upside from here. Yeah,
I just wonder if there's at some degree a buyer's strike in that name for all the reasons that we've discussed since the CEO of UnitedHealthcare was murdered. Diamondback, quickly.
Yeah, so they made another acquisition this week of Double Eagle, and it's going to be free cash flow positive by 5 to 6% this year, next year. This is the sixth acquisition that this company has done since 2020. And every deal that they have done, it's accretive to free cash flow. And they have the highest oil and gas production in the industry. And it's just the largest pure play on the Permian, which is the fastest growing piece within the U.S. that you want to be exposed to. It trades at 10 times EBITDA, 10 times earnings. So I think this is a really good move for them, and I like what they're doing overall.
All right. Good stuff. Steph, thank you. We'll see you back on the desk.